A lot of people have been reaching out and asking how to start investing in bonds, what platforms to choose, how to do bond selection, your allocation, what expectations to have. So I thought I'll make a quick video around how to start investing in bonds for a beginner. Now, I am not an expert. I have been investing in bonds for just 6 to 8 months, but based on my experience, I can share some of the insights. Now, to start with, the first thing that I tell people is that you need to have a clear understanding of why you are investing in bonds. Just like any other asset class like stocks, gold, or real estate, etc., you need to have clear expectations and be clear to yourself. For example, I invest for diversification and my target IRR is around 12%. I have seen a lot of investors who have different use cases. For example, they use bonds for regular monthly income. Some investors use bonds as an alternative to FDs and invest only in very safe bonds. So their target IRR is around 9 to 10%. So all of these use cases are great and they essentially depend on your requirements. So you need to be clear on why you are entering or investing in a particular asset class. So the next question is what platforms to choose for someone who is starting investing in bonds. For this, I usually have a very straightforward answer that you can go ahead with any OBPP platform. These are SEBI-registered platforms that facilitate buying and selling of bonds. I have been investing primarily through Grip Invest in bonds. I have done some investments via Wint as well, but these are just personal preferences. I think that most of the platforms, I think there are around 20-25 platforms as of now. All of them should be good. Till now, I haven't seen any delays or defaults on Wint or Grip. I usually prefer Grip more over other platforms because it has the right balance of risk and returns for my risk appetite. Now, the most frequently asked question is what bond to choose or what deal to select. There is no right answer to this. All of the deals are personal choices, just like you invest in stocks. Some investors like Tata Steel, some other would like Jindal Steel. Similarly, it's in the bonds as well. But one generalized recommendation that I give to most of the investors who are starting out is that start with the safer bonds. Don't chase high returns from the beginning of your journey. Invest in safer bonds, try to understand the process, how this space works. And then as you keep on increasing your corpus, diversify into higher risks as per your appetite. My favorite parameters that I look while investing in bonds are rating, IRR, and tenure. So I usually invest in less than 2 years tenure bonds, and I invest in bonds rated A or above and target around 12% IRR of my cumulative portfolio. The next part is how to diversify and how to allocate in low risk and high risk bonds. So just like stocks, it is pretty much the same, at least in my opinion, for bonds. Just like every investor invests in large cap, mid cap, and small cap, I also invest in low risk, medium risk, and high risk bonds. Usually my thesis is that I don't give more than 10% exposure to any single company in my overall bond portfolio, but that is not usually possible for everybody. The minimum investment for a lot of bonds is 1 lakh rupees. But say if somebody wants to invest 5 lakh rupees, then they cannot give 10% exposure to each of the bond. So what I recommend in such cases is start from the safer bonds and just keep 20% allocation to each and allocate as per your risk appetite. Don't go for high risk, high returns till you can bring down the allocation to each bond to 10%. I usually keep 30% in low risk, 40% in medium risk, and 30% in high risk bonds. Just like any other investment, when you are investing or entering an asset class, you need to understand that there would be risks. And if you are able to visualize or understand the risks or the quantum of those risks, it just makes the overall journey of investing much easier and more enjoyable. So here's a basic table that I created to explain this concept, how to understand the risks involved in bonds and how to measure them. So let us assume that I have invested in 10 bonds, each bond has 10 rupees. So my overall invested amount is 100. My expected IRR is 12% and the tenure is 12 months. Now, the ideal case would be that no bonds default or delay and I get 112 rupees at the end of 1 year and my IRR is 12%. Now let us take an example where one of the bond defaults And usually when a bond defaults, you don't lose the entire capital, you get some capital back. So for ease of calculation, I have taken that you get 50% of the capital back. So at the end of 12 months, you will get 12% on the 90 rupees. So this is 90 to 12%, and you get 5 rupees from here. So the net value is around 106 rupees, and you get 6% CAGR. Now these are some more extreme cases, and let's talk about this one. Let us assume that 2 out of your 10 bonds defaulted and you could not recover any amount. Even in that case, your net return after 1 year would be minus 10%. And then you can start compounding or start from here. You still have 90 rupees left. In terms of returns, this is very similar to what we have been experiencing since last 6 or 10 months. But in terms of rarity of this event, this is a very, very rare event. This happens once in 25 or 30 years. So the possibility of this happening is very, very low. Now, to give more realistic picture on bonds default rate and what to expect from bonds, this is CRISIL's default and rating study around bonds. This is from 2024, and here we can see that the average CDR, that is the cumulative default rates in the investment grade bonds, which are BBB and above, are so low. For example, for 1 year they are just 0.52 for BBB. For 3 year it is 2.5%. And that is why the short-term bonds or short-term deals are usually considered more safe as compared to longer deals, because the chances of defaulting keep on increasing slightly. We have more numbers here, and this includes the SDIs as well. So we can see that A1 plus rated deals, which we do get on GRIP, their default rate of the past 10 years, this is 10 years data, and hence this includes the COVID fall, everything, they are just 0.02%, right? And for BBB it is 2.18%. Now if we come back here and take the 2.5% as default rate, so we can safely put this at 9.8, and we can see that the net IRR is 10.6%. We have taken into account the average default rate of BBB bonds here. If you want to be even more conservative or realistic to incorporate even worse situations, we can perhaps take it at 5%, so it will become 9.5, and even then it is 10.3%. Now the beauty of stocks and equity is that there is no upper limit or cap to how much they can grow. You can expect 20%, 15%, or even 100%. But then they can go down as well, and you really don't know when you need money the most what would be the amount of your corpus. Bonds or fixed income, on the other hand, give you that stability or reliability, and we have seen that you can calculate or estimate things even in the worst conditions of what kind of returns you can get from your corpus. And lastly, you should be aware of the regulatory bodies or the grievances portals where you need to reach out in case you are not happy or you have seen defaults or delays. So the SEBI scores is the go-to grievance authority in this case as well. Apart from this, try to speak to the platforms, their RMs, speak to investors, try to join communities. We have a small but very active communities where investors share their learnings and experiences around fixed income and bonds. These platforms are a great place to start learning and avoid mistakes that other investors have made. So that's it. Have a great day. If you have any questions around bonds or any other financial instrument, please feel free to reach out. That's it. Stay healthy, invest well, and have a great day.